Stocks hit new all-time highs as they forecast a Trump second term, but bonds are flashing a warning signal. And what are gold and Bitcoin telling us? I'm Graham Summers, and this is Bulls, Bears, and BS. Welcome back to Bulls, Bears, and BS. I'm Graham Summers, Chief Market Strategist for Phoenix Capital Research, and today is Wednesday, October 23rd, 2024. So before proceeding, I want to tell you two important things. The first is nothing I'm about to tell you is meant to be interpreted from a ethical or moral or any kind of personal agenda. I'm simply trying to tell you what I'm seeing in the financial system. I'm not endorsing President Trump. I'm not endorsing Kamala Harris. I'm just trying to do the best I can as an analyst, which is to present you similar to how a lens works on a camera. I'm trying to bring things into focus so you can see things clearly. The second thing I wanted to tell you is that we've actually put together a webinar that's going to go live on Friday, delving a lot more into the items related to a Trump second term, specifically what sectors is it going to affect positively, what sectors in the markets will it affect negatively, what does it mean for the overall market, what are some sort of historical precedents we've seen in terms of coming out of a pandemic, such as we just did with so many Fed interventions, all of that stuff in really great detail. The goal is that by listening to that, you should have a better understanding than 99% of investors in terms of what Trump specifically means for the markets and the financial system. That will be going live Friday at 2 p.m. Eastern Standard Time. It's available to the general public for $49.99, but as a listener of Bulls, Bears, and BS, you would qualify for a discounted rate of $19.99. It will be available for playback, so it's not like you just get one chance to listen to it. So again, $19.99, more than 50% off the market rate of $49.99. And it's going to be a no-holds-barred, no BS market dive-in for what Trump's second term will mean for the economy and the financial system, and specifically the financial markets. Now let's move on to what's going on this week. So the stock market has hit yet another new all-time high. In fact, it had its highest weekly close in history. And there's some very specific implications to this. What this is telling us is that the stock market is discounting a Trump win. The reason I say this is because of the two candidates, Trump is the one who's the most vocal cheerleader for the stock markets. Kamala Harris's economic agenda doesn't really involve stocks a lot. She suggested various tax loopholes being closed for capital or raising the capital gains rate. She's essentially mentioned a number of policies that actually would be very negative for stocks. So if there was a really significant chance that Kamala Harris was about to win, you would see stocks struggling to get to new all-time highs. The fact that they're just going up day after day after day tells us very clearly that the market is discounting a president who's very pro the stock market, and there's nobody in history that's more pro the stock market than Donald Trump. Why do I say that? Well, if you look at the Trump first term, then Treasury Secretary Steve Mnuchin openly stated in public that the Trump administration at that time viewed the stock market as a barometer for their economic agenda. So what Trump does is he looks at stocks, and if they're going up, he thinks that's the financial system telling him you're doing a good job. Way to go. The only and as is usually the case with Trump, this is both, true and not true. It's true in the sense that by pushing stock prices higher, you can actually create something of a wealth effect, which is that those people who own stocks feel wealthier, they're more inclined to spend money. So that tends to be an economic boon. But the flip side of this, and the side that's kind of the BS one, is that Trump himself has a tremendous influence on the stock market. And we saw this throughout 2016 to 2020. Time and again, whenever stocks were struggling or looked like they might be breaking down, he'd suddenly tweet something about the market, specifically pertaining to the China trade war, and stocks would just rip higher. And they'd be ripping higher, not on any change in fundamentals. A lot of the times, Trump would tweet things like, talks are going great, or trade war will end soon, just stuff that was very vague and nebulous, and still stocks would go up. So my point with all of this is that with Trump and the stock market, you've got two things going on. One of them is that he sees it as a barometer for what the economy is telling him about his agenda. But on the flip side of it, he actually has a lot of influence on it. And if there's one thing we know about President Trump, it's that he loves both wealth and power. And so what are the odds that this is somebody who's going to relinquish that power and stop talking about stocks and stop trying to push them higher with tweets and sort of public statements? It's very, very low. So the stock market's very clearly discounting a future in which there's a president who's very pro-stocks. That president would be President Trump for the reasons I've just detailed. Now, having said that, the bond market is actually flashing some warning signs to us right now, and there's a specific reason for that. As everyone is fully aware, the U.S. is currently running its largest deficit outside of the it's running its largest deficit as a percentage of GDP outside of World War II. I believe only World War II and the Great Financial Crisis saw the United States running a more aggressive deficit as a percentage of GDP. And this is, the deficit is essentially being financed by debt. It's the United States using debt to pay for things that it can't afford via what it brings in via taxes. Now, historically, every quarter, the Treasury will announce how much it's going to issue in debt. Currently, we're issuing about every 100 days, we're issuing about $1 trillion in new debt. But when we talk about debt, it's not like we're talking about just one type of bond. We're actually talking about almost a dozen different durations. The United States will issue debt from anywhere from 4 weeks up to 30 years. So there's quite a wide range of these things. And historically, when we issue debt, we typically break it down as follows. About 20% of the new debt will be short-term, meaning it's 2 years or shorter, maybe even 1 year or shorter. And then the remainder, the 80%, will be longer-term debt that's 3 years in duration, 5 years in duration, all the way up to 30 years in duration. Now, the Biden administration has been kind of gaming this in the sense that Treasury Secretary Yellen has been relying extensively on short-term debt to finance our deficit. The reason they're doing this is because short-term debt is extremely liquid. There's a tremendous amount of demand for it, and it allows them to game the system because if, for instance, the United States was currently issuing tremendous amounts of long-term debt, the long-term bond markets would balk at this because, again, basic economics tells us the more of something there is, the less it's worth. So if you're relying really heavily on long-term debt, 10-year treasuries, 20-year treasuries, 30-year treasuries, then we would be seeing the long end of the bond market absolutely collapse, which would be very detrimental for our credit standing. It would potentially cause some systematic issues in the debt markets. And so the way I'm looking at this, or the way I'm trying to tell you, frame this for you, is that the Biden administration has very carefully been relying a lot on short-term debt to finance these gargantuan deficits they're running. This is a sort of gimmick that's being employed. It's not sustainable in the long term, and it's currently sort of coming home to roost a little bit. What I mean by that is if you look at the yield on the 1 year or 2 year treasury, both of them have been rising. Now, remember, when bond prices fall, bond yields rise. So what this is telling us is that the bond market is kind of balking or sensing that there's just going to be some kind of shift in terms of the amount of debt that's going to be issued, specifically as it pertains to short-term versus long-term. In essence, what you could say is the bond market's finally getting to the point where it's saying, okay, you can't keep doing what you're doing. You can't keep issuing, $1 trillion in new debt every 100 days. Now, this is going to have an effect on stocks sometime in the next week or two. We're going to see stocks start to correct. I've told our private wealth advisory clients and other readers that you can expect probably the S&P 500 to drop down to the 5,600, maybe even 5,400 range during that time. I see that as a buy the dip opportunity. But the point I'm making is that the bond market is sort of telling Trump, because again, Trump is the self-proclaimed king of cheap debt. He's somebody who really is not fiscally conservative at all. The bond market's telling him whatever the Biden administration got away with, that kind of era is over, and you're going to have to be very careful with how you do things going forward. This sort of fiscal liberal policy of just issuing tremendous amounts of social funding, that's not going to be possible going forward for much longer. So that's going to cause a hiccup, and I don't think it's going to be something significant, but it's just sort of the bond market reminding the president to be that, this is not sustainable and it needs to be addressed. Now, I'm not super concerned about this. One thing that the Trump administration's been hinting at for a second term is cutting a lot of spending as it pertains to public employment. I believe the public sector accounts for something like 4 million employees. a lot of these are considered to be, replaceable by the Trump administration. He's even floated the idea of having the famed tech billionaire entrepreneur Elon Musk come in and do sort of an audit of all the government entities. I don't know exactly how that would work. It sounds really great on paper, but if there's one thing we know about government, it's extremely difficult to shrink it. It's extremely difficult to fire people who work in the public sector. So regardless, if Trump's able to pull that off, that would reduce some of the spending, that would reduce the deficit. But the main sort of big picture perspective I'm trying to portray for you here is Trump's very much a stock market cheerleader. He very much wants the stock market to be going up during his term, but he's going to have to sort of walk a fine line in terms of reining in some of the social spending, getting a lot more fiscally conservative while simultaneously trying to push stocks higher and get the wealth effect that he wants Americans to be feeling wealthier in terms of their stock and their real estate portfolios. So this is all kind of where things are right now. This is what the market's discounting for the next little bit of time. The other thing that we're starting to see, that we're seeing is that the economy and the financial system are likely going to be running hot during a second Trump term. What I mean by that is that the Fed's already easing rates, and Trump has made it very clear that he's got a bullseye on the Fed's back. Trump feels that the Fed intentionally sabotaged his economic agenda during the first term. There is some evidence that's likely the case. The former vice chair of the Fed, Stanley Fischer, said on record that he believed the Fed actually raised rates in December of 2018 specifically to hurt the Trump agenda. So, there is some indications that the Fed may have been playing politics during Trump's first term. Regardless of that, though, it's very clear that Trump thinks that's correct. And so he's already sort of floated this plan where he's going to have the Treasury influencing the Fed more dramatically. It's also potentially opened the door to him firing the current Fed chair earlier than usual. It's also got the potential for him to even be involved in decisions of whether or not to cut interest rates. And he's been saying openly, the Fed has this amazing job. You just, do nothing all month. And then once a month you walk in and you flip a coin and everyone thinks you're a god. So this is someone who's, again, very pro stocks, thinks that the Fed has been a problem for him in the past and that the Fed plays politics, and is going to be trying to put more pressure on the Fed, has already floated a plan to the public to see how they would react to that. So these are all things that tell me it's very likely that at least during the first year or two of Trump's second term, we're going to see the stock market doing overall very well, a risk on sort of, buy the dip environment. But in the next week or two, it's very likely we're going to see a hiccup in stocks. I view that as a buy the dip. Finally, we also see gold and Bitcoin catching flight. Now, these are both essentially liquidity plays, or plays that are related to whether or not the economy is running hot and liquidity is flowing in an ample fashion. The fact that gold's just been on a tear and not even looking back is telling us very clearly that the Trump economic agenda, combined with the fact the Fed is easing, is going to be a very sort of run the financial system hot. It's going to be, inflation can be a problem provided that the labor market stays strong. So again, the idea that inflation might get all the way back down to 2% is probably not going to happen. It's very possible inflation stays higher, maybe close to 3%, in exchange for the labor market strengthening. So it's the way I kind of see it is I think Trump's going to prioritize economic strength over anything else, especially during the first year or two. He might take a hit and allow some kind of economic contraction, albeit a short-lived one, midway through his term. But I think it's highly unlikely he's going to take office and immediately try and cause a bear market in stocks or a recession in the economy. This is a man who's just far too proud, far too egotistical for him to have something like that where the media can just turn and say, well, look, he won and all of a sudden everything's bad. So that's all I've got for you this week. Essentially, the big picture perspective we have is it's very clear to me the stock market is discounting a president who's going to be very pro stocks. It's very clear to me that there's indications that bonds are going to cause stocks to, get a hiccup in the next week or two. Remember, as I've said in my first book, politicians make promises, but bond markets deliver. And we're going to likely see the economy and financial system running hot during the Trump second term. Where the wheels will come off and things start getting dodgy, I'm not sure. It's too early right now. We're only looking out about 6 to 12 months, but that's the way I'm seeing things now. I'm Graham Summers. Don't forget that on Friday at 2 p.m., our webinar that's going to go a lot more into detail in terms of what sectors will perform best what are the investments you want to own during a Trump second term. All of that kind of detailed stuff will be going out Friday at 2 p.m. Eastern Standard Time. You can, as a Bulls, Bears, and BS listener, lock in a $19.99 slot on that as opposed to the market rate of $49.99. If you have any questions, email us at support@phoenixcapitalresearch.com. We're happy to help you find the order form. And that's all I've got for you this week. I'm Graham Summers, and this is Bulls, Bears, and BS.